Hey everybody, welcome to Mortgages Today for Wednesday, August 16th, 2023, and oh, what a day it was. MBS opened up 13 basis points to the positive this morning. Stocks were in the green as well, being up 7 points overnight. Russia's central bank raised interest rates from 8.5% to 12% at an emergency meeting yesterday, the highest level since April of 2022. The move comes one day after the ruble dropped past 100 against the U.S. dollar, valuing at less than a U.S. penny for the first time since Russia invaded Ukraine. Before the announcement, the ruble had briefly strengthened, but its value remains down more than 1/3 since the start of the year. This is mostly due to the flood of money they are spending into the economy to support war efforts. Housing starts rose 4% month over month to a seasonally adjusted annual rate of 1.45 units. This is up 6% on a year-over-year basis. Single-family starts were up about 9.5% on a year-over-year basis, while multifamily was flat. Building permits were flat month over month, down 13% on a year-over-year basis. Home builders have been on a tear this year, outperforming the S&P 500 by 23% year-to-date. New home purchase applications rose 35.5% compared to a year ago, according to the MBA. Yet, builder sentiment remains low because they are a bunch of babies. Industrial production rose 1% month over month, while manufacturing production rose 0.5%. Both numbers were above street expectations. Capacity utilization inched up 79.3%. In the afternoon, we got the Fed minutes. Paraphrase bullet points are: uncertainty remains, future changes are data dependent. Most said more hikes could be needed due to inflation. A number warned about over tightening. A couple favored holding steady. Most saw more inflation risks. More evidence of lower inflation needed. Gradual slowdown economy seems to be happening. Slower growth in softer jobs market still necessary to restore balance. Higher home prices taken as sign that housing response to rates has peaked. Specific focus on the last bullet point, the Fed seems to be overlooking the tight supply situation in housing, which is equally at fault for rising prices. Supply in turn is due to the Fed's over-accommodation in 2021, locking homeowners into rates too low to give up. It's pretty circular, really. So today's Fed minutes were uneventful, with a volume spike that didn't even eclipse those seen at yesterday's 8:20 CME Open or the 9:15 industrial production data. That puts them in a forgettable company among potential market movers. Nonetheless, bonds sold off moderately in the afternoon. This was less to do with things that happened today and more to do with the general trend. Inflation is moving the ensemble cast, while growth, issuance, especially issuance, and yield curve are getting more lines. Closed down 17 basis points on the day. This is down 34 from the best spot of the day. Stocks lost 34 points, so we closed in the 97.73, which is down in this really ugly range bordered by an S1 Fibonacci on the ceiling at 97.984 and a floor at 97.563. So, and 97 coupon is ugly for the potential for getting any rates any better. We have to get a long ways up, otherwise we're going to have to start flipping and looking at other coupons, which is not good. So let's see what tomorrow brings.